Well, good evening and welcome to this live stream on the 2nd of September 2025. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks for taking some of your Tuesday evening out to be with us. Really appreciate it. And we're going to have a really interesting conversation tonight with Damien about the markets. What's going on? What are the dynamics? What might happen? How should investors think about things like Fed independence? Is that important or not? What about are the markets toppy? October, September tends to be a bit wobbly sometimes. What does that mean? And how do we measure what's going on? Is GDP a good measure? The latest numbers from the Australian perspective don't look pretty wonderful. They're sort of feeding into the full GDP shortly, of course, with the trade gap and a few other things. There's a lot to talk about tonight, so it'll be very interesting. Just before I bring Damien in, I'll remind you that we don't provide specific financial or legal advice. This is a general conversation only. We moderate the chat, but feel free to throw your questions and comments and suggestions as we go. If you'd like to ask a specific question to Damien or myself, if you use Outwalk the World, that'll get it into my queue. Make sure that I see it. I've also enabled Super Chat, which means you can get your question to the top of the list, or indeed make a contribution to what we do around here. Really appreciate those who support us. We don't do this for profit. We do this because we think there's a really important conversation to be had. And you can support us via Super Chat or Patreon or even PayPal. Details below. Having ticked that off, let me bring Damien straight in. Damien, welcome back.
Martin, how you going?
Yeah, pretty good. I can't believe it's a month. It goes so quick at the moment.
I had a 10 days off in India and Thailand, and so yes, you're sort of back up all your work before that and back it all up and then try and catch up on everything you missed after. So yes, it's been extra busy this month for me.
Yeah, I always think that a holiday is a bit like a tsunami, right? Because it sort of all builds up and then it sort of breaks, but then you've got to sweep up the mess afterwards.
Exactly.
But I'm sure it's worth it. Now, I'm really pleased to have you on again tonight because, of course, there are a number of interesting questions and observations out there as to what's going on and what may be happening. I thought this was quite an interesting place to start. This is from Lisa Brinovich, of course, from Bloomberg, highlighting the fact that the S&P 500, 10 largest companies in the S&P 500 now account for 39.5% of the total value at the end of July, most ever, according to Morningstar data. It's AI and a couple of, few companies. And of course, people have been trotting out the whole range of different charts. This is another one which I thought was quite interesting. Stock valuations hit a new all-time high based on the PE ratios, comparing it with 1929 and 1999 and 1965.
Which one's that one? Sorry,
this is from Bloomberg. So this is the PE, the trailing PE values.
Trailing PE, forward PE, Cape. Yeah. So okay, right. So it's looking at a whole bunch of different measures.
Correct.
Okay.
Exactly.
No,
Right.
That one makes sense to me.
Yeah. So it's basically it's a mix of different elements. And then this one, which I thought was quite interesting, whether you come across this one. This is the global equity risk love thing, which is another way of looking at it. And they're saying, oh, you're near the top again. We're in euphoria. There are some various signals. So, almost however you look at it, people keep trotting out these charts to say, oh, it's looking pretty toppy, And then just to sort of to finish the story, of course, we've got now a greater proportion than pretty much ever of passive funds under management, which of course means that if things do change, then almost automatically the balance of investments in those passive funds will change too. So does that create more dynamics and more uncertainty? So there's a whole bunch of interesting questions that perhaps we can explore a little bit in terms of, are we really in a toppy situation, or is the world looking at it perhaps wrongly?
Yes, and okay. So let me give the short version of it, and then because I think there's a lot of nuance to this that is sort of that's worth getting into. The short version is it's vulnerable. Things are expensive, and there's lots of different things that could blow up and cause problems. So that's sort of like the big picture. But if you keep seeing strong earnings growth, and we are seeing pretty strong earnings growth just coming through, then that cures everything. So pretty much regardless of whatever you're using in terms of these valuation metrics, they're always, price on, well, assuming you're putting price on the top or the bottom, but let's say we're going to put it on the top. You've got price on the top, you have something on the bottom, some sort of valuation metric, cash flow, sales, earnings, whatever it is. If that bottom increases, and it has been increasing, we're looking at the sort of 11% last year, looking like another 11% this year, with earnings starting to sort of, after having a bit of a lull in the middle of the year, the earnings forecasts are actually been picking up sort of post this last reporting season, then that cures a lot of evils. And so it's just a question of whether that can, whether that can hold up. Um, the concentration stuff is really interesting. I've got a bunch of charts actually. I can show on those, but it's a lot of it's this sign that what the stock market is not the economy, and I'll move into that because it's that in big picture sense you've got your consumers, then you've got all your small businesses, and then you've got your government, and then you've got the stock market, and so there's that could be very different. And then on top of that, with this concentration, the broader economic market is not necessarily the stock market that you're investing in. So as you said, we're talking about this concentration of the top 10 of the S&P index being what was it, 30, 40%?
Yeah, 39. Yeah.
39%. Which, is compared to Australia, is, that's it's quite low relative to Australia. And actually it's pretty low relative to most countries around the world, actually. But also it's that part about saying, well, if 40% of your stock market is in just those 10 names, and you can see the S&P 500 going up, even if the average company is falling. And so you've got 250 companies all falling, another 100 companies going nowhere, another 100 companies doing a little bit. And if the top 50 is really putting on, and that top 50 includes some of those top 10 names, and you can have a booming stock market, despite the fact that half the stocks are actually falling. And so, so I guess it's the nuance within this is, it really depends on which ones are hurting within these, whether it's within economy or within the stock market itself. And so, let's that's the sort of, I guess, the brief view, but let's maybe dig into some of the nuance behind it. I think
Yeah, and my observation is, if you think about the US, and obviously the US is one of the largest markets, so we should focus there a little bit as well as Australia. Up till relatively recently, it's the consumer that was driving a lot of the momentum in the US. But in the last year, 18 months, the amount of investment in AI by some of those large techs paying money effectively to other of those big techs has really distorted the story. So in fact, the momentum is less about what the consumer's doing. It's much more about what those big techs are, what the hyperscalers are doing.
Yeah. So yes and no. So this is my nuance on this relative to the tech boom. So to me, the tech boom, we went through this big valuation bubble, and for anyone who some of the younger audiences, sort of back around 2000,
I
there's this
remember it
really
well.
big rise. Yeah, huge rise in all these companies that just didn't make money, that were valued at these massive levels, was the primary driver for it. And in a way, effectively, what was happening was companies were going out raising money because they were saying, you put .com at the end of your name, and your share price would double overnight, and then you raise all this money, and then what do you do with that money? Well, you go out and start buying services from all these all these other .com companies. And so in a way, it was really the stock market driving the profits of these companies, in that it was the whole machine was fine as long as you could keep raising capital in order to go and or somebody could keep raising capital in order to go and spend the money at all these other companies. That's not the case at the moment. So that's the amount of capital raised to sort of plow it into. There's certainly lots of stories of hundreds of millions of dollars being raised, but that's not what's really driving the profitability of these ones. It's a lot of it is companies and governments as well pouring lots of money into these AI projects and wanting to run all these tests, and so it's sort of I sort of think about it as being sort of three broad tiers in terms of how you're looking at it, or probably maybe four actually, I should say, is that at one level you've got people actually out there buying these products, whether it be paying for your OpenAI or paying for um, services to some of these artificial intelligence based ones, based sort of providers. Then you've got some of the sort of this layer of providers there that it's sort of that are like your OpenAI and the people making that software, and they sort of range between ones that really aren't profitable at all, and are basically just trying to capture market share, and they're in that sort of classic, boom type. You'd say a lot of those companies, a lot of them won't be around in 5 years' time, and there'll be a couple of them that'll be massive winners. And a lot of those anyway aren't really listed. They tend to be, these unicorns they talk about, these private equity type unicorns that are sort of that aren't even listed. Then you get into the people providing the services to those. So all those hyperscalers, so your Googles and your Amazons and Microsoft, who are providing genuine software services and charging for it and making really really good money out of it. And so while they're out spending, literally hundreds of billions of dollars building new data centers, well, they're making money on the other side of it, and not from just people who have raised money who are then spending it. It's actually mainly from the companies and the governments who are actually genuinely out trying to explore this and not wanting to get sort of stuck behind. And then right at the end of that, then you have the Nvidias and and Broadcoms and people like that who have got this technology that is just crucial to running this stuff really really fast, and so they're really benefiting from having having that product that these hyperscalers need. And so yeah, uh, there's not as much sort of bubble behind it. I mean, there's definitely bubbles in some areas, but there's still some genuine money being spent and some genuine value being derived from these in terms of productivity gains. And so that's the sort of, and I don't think it's quite the same, at least yet, in terms of this whole idea that we're raising money to buy products that you didn't really need, and the only reason you've got the money is because you just raised it at some ludicrous multiple, and then everyone's buying ads from each other to try and collect more as many eyeballs as they can, and yeah, and so that's sort of that. Yeah, so I don't think there's much bubble behind that. I feel like I feel like you asked me a question. I've led off into a different direction. What
No,
was the
no,
original
no,
question
no.
again?
My point really was that the consumer, which was the foundational growth engine of the US
Yeah,
economy,
that's
right,
right.
has
It's no longer
faded
there.
slightly because of this
Mm,
AI overlay. And as you say, it's
yes.
government and it's
Mm,
other corporates who actually already have quite a lot of money in their back. Microsoft, for example, sitting on huge amounts of
mm.
dollars that they can throw at this, and the amounts of investments they're making. So there is a different flavor to the economy in the US, is my point. So when you
Mm.
actually overlay the normal approach of saying, well, you should look at GDP and that should tell you something, maybe it doesn't tell you that much now.
No, that's right. And so, and the other thing to keep in mind is in terms of concentration. Um, So the MSCI, which is a large global organization that does indexes, global indexes is what they're really well known for. They have a methodology that basically says there's sort of two levels of indexes they have, which is one is MSCI. Which I'm not even sure what they call it. They're large cap indexes, I think is what they call it. But anyway, it covers 85% of the free float adjusted capitalization. So basically, you look at companies and you say, News Corp, Rupert Murdoch owns whatever it is, 15-20% of that. And so we're not going to count that because it's not actually out there and traded on the market. So you're just going to look at when you value news, when you say how big is News Corp, you're just going to look at the 80% that other people can get out there and buy. And so that's your free float. So it's and then you say, well, how many stocks do you need to get to 85% of the market? In Australia, it's 60 stocks. So you can cover 85% of all the listed stocks in Australia with just 60 odd stocks. Um, you know, globally, it's about 1,300. So, really not a big number in terms of the millions of companies that are out there. If you want to get to from 85 to 99%, so of the free float adjusted market cap, In Australia, you only need 225 stocks. So the ASX 200 plus another 25 stocks will get you 99% of the available sort of size of the market out there. And for the world, it's only a bit over 5,000. So something like the US is about 2,000. You can sort of think a lot of the numbers in Australia you can just add a zero and you get to roughly get to what's in the US. So it's this idea that yes, there's concentration, but that's the way things. And there is more concentration at the moment, but not heaps more. Like that's just the way things are. Like and the way things have always been. Um, yeah, we spoke about, so the US is more concentrated than it's been at the moment, but that's not uh, it's not. You look around, a lot of other markets are way more concentrated. Most other markets are way more concentrated. Um, and that's probably one of these ones. I've got a chart up just that'll show. This is sort of quite a famous one from J.R. Ritter is a big writer of these, GDP versus equities, and this is showing the green line on this chart is showing the real equity return, so adjusted for inflation equity return over 100 years, and the yellow line is the per capita GDP, and there's a negative correlation between the two. So Australia, US, South Africa, Sweden, sitting at the right hand side, have got the best markets and some of the lowest real GDP growth. And so that's 100 years ago. Well, 100, what is now compared to, well, back 1900, you say, well, look, if you took the last 30 odd years and looked at emerging markets, you pretty much get the same type of thing. So you get Mexico with basically one of the lowest real GDP growths and one of the highest real stock returns, and China the opposite way. The highest real GDP growth. There are some questions about their numbers, but it's been really high, and some of the middling at best stock market returns. And it's that thought that the stock market is not the real economy, and it's and then within the stock market it's different as well. So if you looked at say the US. About 45% of employees in the US are employed by small businesses, which are not listed on the stock market. About the same amount of the GDP is small businesses within the US. Then you add in government, and you just don't have that much GDP left to spread out. So it's really that idea that not only are we not talking about, not only is all the companies in the stock market not the same as GDP, all the companies in the stock market are then it comes back to that very small number. What was the other one I wanted to say on that was also, oh yeah, and then the other thing you get is within these mega caps within the US, and it sounds weird to say, but it's actually very hard to measure how much earnings come from overseas. There's all these different ways people try and do it, but it's probably somewhere between 30 and 40% of S&P 500 earnings are from overseas. If you look at the largest stocks in the US, and then you said, well, what's US GDP doing? Well, that's only going to tell me 60% of the story. So, and what happens as well is we've actually seen a relatively weak US dollar. And so when the US dollar is weak, the effect of that is actually to inflate the earnings of anyone who's got money, of any of these companies that have overseas earnings. And so that's been part of the reason for the strength that we've seen in corporate earnings is falling US dollar for companies with overseas earnings.
Yeah, very interesting. And I suppose it takes us to a slightly different angle on this. Of course, there's been a lot of discussion about the statistics, the official statistics that are produced. The BLS problem, the head of the BLS being sacked by Trump, and we're trying to recruit somebody who's got a different view of how statistics should be reported, which is interesting. What is truth? We've had issues in Australia with the ABS saying to people, well, you can't use the in and out visitors numbers to actually do anything to do with the proxy for migration, despite the fact migration numbers are delayed heavily, and despite the fact that other government documents say those other in and out numbers are quite a useful early indicator. That we've got the ABS also saying, well, some of our surveys don't really work, so we're not going to publish some data that we normally publish. And in the UK, the retail data, which was due to be out, they've postponed it because they don't think the numbers are right. So you've got this question beginning to build about to what extent are official statistics accurate, relevant, and appropriate. And I'm trying to understand how you, as a sort of a market investor, are reacting to the question of whether those statistics are. I mean, were you ever looking at them? Do you ever think they were meaningful, or did you always have question marks? I'm thinking of China. You know what they say about their numbers, for example. Is it always with a large pinch of salt anyway?
Yeah, look, it is. I think there's one of the first things you can do if you're interested in some of these is have a look within the studies themselves and have a look at what their error bands are, because quite often they're a lot wider than you think, and especially in some of these smaller surveys, they come up and say, oh look, we think XYZ indicator is grew at 1.5%, and our error band is plus or minus 3%. And the market's worrying about, did it come in at 1.5% or did it come in at 1.8? And you're like, well, they've told you within the error band, they don't know. They think it's somewhere between -2 and +5, really, if you sort of spread it out across those. And so worrying about whether it beat by this much or not, might be, interesting from a bond market perspective, or if you're trading some of these on a day by day or hour by hour basis. But really, most statistics are really just a broad guess at what the right numbers are. And so I think it really does mean that what does it mean for you? Well, you need to be taking a whole bunch of different things into account. And that's the way I think most investors, or most of the larger investors will look, is that one statistic can tell you, let's say it's jobs growth in the US, can give you some terrible number, and then 3 days later you get a different job statistic that flips completely in the opposite direction. And so if you're getting those competing ones and bouncing around and all that type of stuff, like you're looking at all of them and you're sort of saying, okay, well, it's uncertain, it's probably relatively steady. Whereas when you start seeing all of them all pointing in the one direction or up positively or negatively, then you get a lot more confident that's where things are really going. And so I think there's definitely that part of it. But knowing that someone's going to lose their job if they give the wrong statistic for something which clearly they've got no say over is not heartening. We've seen the China go through this period of I'm sorry, I didn't mean to grab that chart, I completely forgot of where the number of statistics they were putting out from 1990 grew exponentially through into the 2000s, and then as Xi came into power, they dropped off cliff and they sort of headed back down again. So it's basically people. The idea would come out, they'd have three different statistics saying things were great, and then two other ones, sort of more esoteric ones showing how terrible things were. And they'd be like, well, stop publishing those two. We want to pad the stats and show what we want to show. We don't want people being able to, if A plus B equals C, we don't want people to be able to, back solve and work out that we have to be lying about what A is. And so, let's just present statistic A and B, and then without presenting what C is from a different measure. And so, I think there's a lot of that within it. And then you're just knowing that most of these statistics are, just very broad guesses, is really, I think, the way most investors would look at this. So concerned about it, but there's not much you can do about it. And there's a question about how much you trusted the statistics in the first place. Is, well, I trust them as much as I know that they're only estimates.
Yeah, and that's my point. I've always believed that a lot of the official numbers, you need to understand how they get them. Relatively small surveys, as you say, with the error rates and everything else. And then you've got to understand how they process them. So seasonality and the seasonal adjustments, well, that's based on the assumption that what happened back then 5 years ago is still relevant now. And, with COVID, and you say, well, is that relevant? Another example is interesting. If you look at the US GDP result, which was quite strong. One of the reasons it was so strong was because of the deflator they used on the inflation side, right? And so you can mess around with what the GDP number is, not only with the input data, but also with the other deflators that you use through the calculations. So I've not been at all surprised to find that people are saying, "Oh, you mean these numbers aren't actually as robust?" No, they're not. They've always been a bit of a sniff in the wind. Now, if you get a whole series of information points that all point in the same direction, then you start taking them seriously. But when you have, for example, in the US, some employment numbers up, some down, some looking really sick and some looking really quite powerful and positive, then you've got to say, well, there's no strong indication either way. And if you're the Federal Reserve, of course, the Federal Reserve says, well, we're waiting to see what the evidence of our data sets are. And, when the data is conflicting, which is what it is at the moment, it's not surprising that they're saying, well, we're still waiting to see how this tariffs thing is going to play into the data or the employment, et cetera, et cetera. So I was quite interested when Powell at, the central bankers Lovin a few weeks ago was saying, well, we understand that there's a contention between the jobs and the inflation number, and depends on how far you are from the two. And they also said, and we're not going to allow the underswing of inflation now to be overcompensated for subsequent. We're going to try and keep. Yeah. So I mean, to me, this is all mumbo jumbo. This really didn't say anything new at all.
Yeah, and the other big thing on jobs in the US at the moment, I'm sure I spoke about it last time, is the number of people who are being arrested and deported is obviously much higher than we've seen in the past, and the number of people coming into the US is a lot lower than in the past, and that's all unofficial numbers, and so what's really going on is then extra hard to read because we just don't see what those happening to those numbers. And using the example of you're a restaurant and you've got 20 staff and 5 of them are undocumented and off the books, and so you've got 15 official staff, and now you can't find any more undocumented people, or you're finding it hard, but also the economy is turning down, so maybe I'm going to cut from 20 staff back to 18, but I can't find the undocumented people, and so now I've had to add 1 extra staff, and so it looks like I've gone from 15 to 16 staff, whereas really I've gone from 20 to 18. And so is that being captured? No, it's probably not being. Oh, sorry, I'm sure it's not being captured. What's the overall effect of that? I've got no idea. And people can guess and look at things, but you just sort of need to recognize, well, right now, not only is it are these employment numbers naturally uncertain, they're even more uncertain now because of underlying changes within the structure of the US economy. And
those structural changes, and in fact, Powell said this at the last press conference, it's taken down the demand for staff. It's also taken the supply down. And so the net average is pretty much as it was, it's just that it's slightly different from what it was. So yes. Pretty important to understand that. And in Australia, there's somewhat true as well. I mean, the unemployment numbers that we have in Australia have some of the same question marks because, of course, it's depending on the way the surveys are run. Some of the other employment data depends on the business surveys in the US, for example, and a lot of people not responding to business surveys in a timely manner anymore, and them trying to adjust for it. So
which is effectively what they got the person sacked, wasn't it? That
exactly right. Yes.
Used to get whatever 90% through by the first bit, and now we're getting sort of 70% through, and you don't get 90% for a couple of months after, which is why the revisions are much bigger.
And that, to my mind, is why the markets really didn't react that much. And it seemed to me, on one hand, everybody builds up the next information release. I suppose there are TV channels who specialize in hyping the next jobs number or whatever. Well, actually, when you look at what the numbers are doing to the markets, it seems to me that people have got a little bit beyond it in terms of actually reacting to every number that comes.
Well, and the other thing that has happened especially over the last sort of 5 years, is there's a broad range of alternative data suppliers out there that sell a lot of information, particularly to investment companies, and for lots of money, like hundreds of thousands of dollars. And so, what are the types of things? Well, counting ships leaving leaving China, or you're using satellite data to work out, foot traffic or demand or whatever it is in terms of these sort of big data sets that they have, or just more people spending money uh, online and using credit cards and things like that versus what might have been done, particularly in the US, 10 years ago. It's still pretty common for people using checks and lots of cash, whereas now, lots more. And so there's just these other data sets out there that just aren't published. And so when financial markets look at the headline figures and they're going, well, that's different to some other data series which I'm paying $100,000 to get special access that nobody else gets. That's can I think that's at play as well. Is that there's if you compare it to how it was 20 years ago, the official providers were the official providers. And actually, Martin, I suppose you sit into that category as well yourself. You've got your own data there, which is different to make the you obviously announce it here, but it's an alternative data set, and it's a massive amount of people that you're using, and it probably is bigger in a lot of the cases than what the government's some of the government official stats are. And so it's the part about saying, well, if you've got if I'm buying that data from Martin or getting this data from Martin and I'm getting it from somewhere else and somewhere else, and then I see the official stats say something different to what I've got from these other surveys, well, maybe I'll go with the ones I'm paying the money for.
Well, I certainly do have clients who use my data to help validate or not some of the other official statistics, because of course the methodology I use is different and it's quite granular, and that granularity is something they don't get in many other areas. So yeah, you're right. Some of these big organizations and hedge funds and those sorts of organizations have deep pockets and grab information from all over the place to bang into their models and then run them through their AI and do whatever they want to do with them. So it is fascinating, and it's all becoming much more real time. So people are now asking me for information not just at the end of the month, but they want it almost more frequently, because they want to try and get on the latest wave of the data. So
Right.
time frames are getting more complex.
I'm going to give you public advice on business advice for you. Is that sounds like something that hedge funds would pay a lot of money for.
They do,
and they would in other things, they might end up paying 50 times more than the price that people get it for the end of the month or something like that in other data series that I'm aware of.
Funny that
they're like, yes,
that's how we do it. So if you want it to, if you want it at the end of the month, then you'll get it at one level. But if you need it next week or this week, then by definition, there's a bigger price ticket. But
yes.
we should thank them, because they help to fund some of the stuff I do here. So that's the way it works. Now, just take the conversation forward. I've been very interested in the bond markets and the way the bond markets
But before we get to the bond market, can we quickly go through, because I think there was I've got a couple of things written I wanted to circle back to on this concentration and valuation.
Yes.
First one I might hit up is the valuation one. And you put up that one. I've got a similar chart, which the Wall Street Journal ran today or yesterday, which is the price to sales ratio, and just showing that I guess the headline was we're in a bubble. It's never been higher. Even during the tech boom, the tech boom sort of peaked out at under 3 times price to sales, and now we're at 3 point something or other, 3.25 or something like that. Now, there's compositional things going on here, and so this is there's two big things that make a difference to this. One is over time we've seen fewer manufacturers and more service companies, and service companies tend to have higher margins. Now, part of the reason for that is they don't have these huge bits of capital that they're investing in, so that you don't have sort of it's not that I built a factory and now I'm depreciating that factory, and so that's sort of running down my margins and things like that. And so so that's one part of it. There's lower taxes, and then the third one is you have seen a lot of outsourcing of outsourcing of a lot of the lower margin types of business. And so what it means is that, look, price to sales, is it really comparable over time? Like if I've got different companies, do I really want to look at that? And it might be that an Nvidia type company, say in 2000, would have had to create the factories itself, build up the work, have this huge workforce, have all their people out there sitting there, making the chips and churning it out and selling it, and so they would have had much lower margins. Whereas effectively what we're really looking at now is a business like TSMC, which is the one that does all the actual manufacturing for this, sitting in one part, which is much lower margin, and then Nvidia just making these really huge margins on the end. Or if you look at like probably even more stark a company like Boeing or something like that, where yeah they used to do everything, whereas now they've just outsourced all the low cost, low margin stuff. Is like, well, why are we doing this in the first place? If it's a commodity type business, we'll just let somebody else do it, or it might be done by small businesses or things like that. And so what it means is their price to sales, and maybe if you looked at the entire, making of a plane, the price to sales across the whole group might be similar. It's just that the listed part of it now has much bigger margins, and the unlisted part of it has much smaller margins. And so, yeah, I'm wary of looking at those types of ones. And the other one is price to book ratios. You'll often see the definition of what book value is has changed dramatically. In 2000s, there was a fundamental change to accounting standards that means that price to book is just not the same as what it used to be. And so, and broadly, broadly what the change was is, for the preceding 100 years before that, you could write your book value up and write it down. So you run into problems and you go, oh, look, I've got a factory. All of a sudden, we're not producing whatever it was because the economy's turned down. I'm actually going to write the value of my factory down by half. And then 2 years later, you're like, actually, you know what? The economy's bounced back. Factory's running really well. We're going to write it back up again. And so that's what you do with your book. Whereas nowadays, you can write stuff down. Writing up is almost impossible. Like it's all very, very difficult to write up. And so we've got this equity that's like you can force it down but never put it back up again. And so when you talk about a price to book ratio over time, it's just not the same ratio you were ever talking about before. And so and that throws out a whole bunch of things. So your return on equity calculation, so return on equity is basically how much profit are you making, how much equity have you got? Well, if you keep writing the bottom down, but you're never allowed to write it back up again, and you've got your return on top, well, return on equity just keeps growing and growing and growing. And you look at companies like IBM, got rid of all their manufacturing and everything and kept all their services revenue, and their ROE went to like 70 or 80%. And but nobody thought that they were actually, these guys were investing $1 and making an 80% return. If that's what they were getting, that they would have been the price like Nvidia, and they'd be pouring as much money into the company as they could. All that was happening was that their denominator was shrinking faster. And so, yes, you've got that. Plus, you've got share buybacks, which are, weren't a thing sort of pre-2000s, and they're sort of playing around with the equity as well. And so, I think I always take with a grain of salt whenever I see uh, ones that sort of focus on particular ratios and say, yeah, if you look at this ratio, this is whatever it is, you need to dig back into the numbers and just get a broader feel about what's changed over time. Um, and there's even if you sort of look at some like the cyclically adjusted PEs and things like that, even some of those have some pretty meaningful problems. I've published a few charts sort of trying to get to the bottom of how you really should adjust it because um, even company profits, in the 70s and 80s, when you had really high inflation, what would happen is, I build a factory for $100 million and I'm depreciated over 20 years. So, spend 100 million, I'm depreciating 5 million a year for the next 20 years. 10 years later, the cost of building a new factory was no longer 100 million. Now it's 500 million, but I'm still only depreciating 5 million a year. Whereas I should be, because of inflation, I probably should be, I'd never be able to build a factory at that same cost. And so the actual, my profit looks really good because I've got this artificially low deflationary number. And when they went back to companies and asked them to, they'd actually, the stock exchange would actually go to companies and say, can you publish some numbers, not official numbers, but publish some numbers showing what your profits would do if you adjusted it to the actual cost of replacement. And all of a sudden they're like, yeah, our profits would be down by like 70%. And so you might have seen PEs back in those times of like, 8 times PE or 10 times PE for the market, but it wasn't really 8 or 10 times PE because everybody knew, and it wasn't like it was hidden information, it was public information. The stock exchange were asking companies to tell them, and they were saying, yeah, our profits double what it should be. And so, well, if your profits double what you should be, then you weren't really trading on a 10 times PE, you were trading on a 20 times PE. It was just that, the way accounting standards worked was that was what you were announcing. And so sometimes when you look back at these time series, particularly long time series, and look and see what the relative ratios are, it's really just a reflection of either changes in companies and how they manufacturers versus service companies and things like that, or sometimes it's a change in genuine things that people knew about at the time and were in their own minds were making changes for it. But 20 years later or 30 years later, we've forgotten and we're just saying, well, here's a time series that must be right.
Yeah, absolutely. And a good example of that is actually the way that banks do their provisions for bad debts, right? That has changed
Yes.
quite significantly over time, and yet people still make comparisons from 20, 30, 40 years ago. And the other is, of course, that the way that they actually can take their profit down and then reinstate profit later if they mess with the provisions is also something that people don't really get to understand, which means that they can manipulate their results quite a bit more than people perhaps sometimes think.
Yes. Yeah, that's right. That's you sort of talk about it, the job of an analyst is, the whatever happens actually happens. Then accountants take it and turn that into something, and then management grab what accountants take and turn it into a great story.
Mm.
And the job of an analyst is to take that, undo all the management changes, and then try and work out all the accountant changes and try and get back to actually what genuinely happened.
Well, I can tell you that when I worked at Anderson, I was surprised to discover that, in fact, the accountants would sit down with the managers of the company and say, well, what do you want? Right.
Yeah.
So it's not even a linear process. It's iterative between what the accountants do and how they actually, the auditors, etc. So the whole thing is way more flaky than people perhaps would think.
Yeah. And I wrote something a few years ago. I should republish it actually because it's I should do it every now and again because it is an interesting thing. It's this whole idea about when you see these independent valuations, most independent valuations, it's there's a CEO somewhere and another CEO somewhere or a chairman somewhere and another chairman somewhere who've made a deal and they're like, right, our company's going to buy your company for $5 billion. And then they turn around to the guys doing it and say, we're going to buy it for $5 billion. Can you justify it? And they go, right, I know what I'm trying to get to. And so, if you're the person, if you're an analyst working there and you're like, no, that's not the way you do it. This thing's only worth 3 billion. Well, thank you very much for your service. You can go and you can go find yourself another job. I need to find somebody who can come up with a 5 billion valuation.
Oh,
If you can't, if it's not you, then I'll find somebody else.
Yep. And I've actually been involved in some transactions years and years ago when people actually went through that process of a beauty parade of different advisors until they found the one that would give them the answer they wanted and then went with that.
Yeah.
Right? And pay them a lot of money to basically tell them what they needed to be told to be able to get the transaction they already wanted to do to go. So, there's a lot of stuff below the waterline that people wouldn't actually ever understand.
Yep. You're working backwards to get the answer. So yes.
Exactly right. Now, you said there were 2 points. I think we covered one of them, which was to do with this question of the way the markets think about value. Can I go on to bonds, or did you have another point you wanted to make as well?
What was the other one I just wanted to highlight? Oh, is the active passive. That's right.
Oh yeah, good. Yes.
So there's a couple of parts to this. So first of all, on the active passive is it's not so it does make a difference the fact that people are putting money into active or passive. Oh yeah, so what's this one? This is 53%. Yeah, okay, that probably matches up to the stats I've got. Because yeah, there's passive and there's like sort of there's stuff that's sort of not completely passive, but it's really, really close. And that probably takes that chunk even higher in terms of what's out there.
Let's just do a quick definition. So active basically means that there are fund managers making active investment decisions, right?
Yes.
The passive is effectively funds that track indices or some other algorithm, but there is no separate manipulation of the fund mix other than those factors.
Yeah, that's right. Now, On the and we do both. Nucleus, I've got both these, I'll sell both my products here. So one of it, I'll use myself as an example. So we have a fund, an international fund. There's 60 odd stocks in it. We go out and try and we can invest in anything in that MSCI world, which is that sort of 1,500 stocks that I spoke about being the top ones, top sort of 85% of stocks by market cap. And we just go out and try and find the best ones we can. Then we have a passive one, which you sort of choose how many stocks you want in it. But say you want, a 75 stock portfolio, it's got the top 75 stocks. Chooses it by the biggest ones, puts the most in the biggest one, and second most in the next one, and all the way down. Now that's a pretty common strategy. So if you're talking about, say, the S&P 500, that's the top 500 stocks chosen by market cap weight. We choose it in the same way, and what it means is the fees can be lower for those because you're not getting the expertise and the performance and risk management side. But it's a way about saying certainly over the long term is going, look, I'm just going to take I don't really care if market's going to go up, market's going to go down. I just want to buy that and get me in at a cheap price and go for the ride. So within that. Within that basket, there are lots of other different ways you can do it. So within the passive funds, though, most of it is that index base. So what you're doing is you're buying the biggest stocks. Now they've done really, really well for the last 5, 10 years. And part of the reason why everyone talks about this is because about how great index funds are, is because fund managers tend not to be overweight large cap stocks. And so what I mean by that is you've got a selection of 1,300 stocks to choose. You're going to pick 60. What are the odds that you pick the 60 you pick are all the biggest ones, and you end up going, oh, well, actually, you know what? I really love Nvidia, which is whatever, 8% of the index. Let me take 20% of it, so that when it goes up, I do even better. And so what happens is active fund managers tend to be have a bigger weighting to smaller cap stocks, and then passive ones tend to have a bigger weighting relative to active managers by size. And so if you look at the sort of performance over long periods of time, if and what I'm going to use is an equal weight, because that's another one people talk about is saying I'm going to have an equal weight index. And the thing with an equal weight index is sounds great in theory, but you go out and buy 500 stocks in the S&P 500 all at equal weight. The next day they're not equal weight anymore because all the prices have moved. So what are you going to do? You're going to start selling and buying, or you're going to wait till they hit a sort of band? And so you wait till they go move a little bit, and then you start selling and buying and back. So first of all, you're trading a lot, and the ones that are going up. So the ones you're actually so you're taking your profits on, and now got to pay tax on that as well. And so those equal weight ones are doing that. Now, if you can ignore all the tax effects and everything, equal weight sort of beat market weight by 2% per annum over sort of this 50-year period between 1960 odd and 2015. It's great. So I've done, looks good if you ignore the tax side of it. Then you go, well, you take a shorter time frame, and so from sort of 1990-ish to sort of 2023, it beat it by about 1% per annum. So you're talking about a 30-year period there. It's beat it by 1% per annum. Well, in the 2 years since 2023, market weight has beaten equal weight by 35%. So you've got 30 years of like 1%, eking out these 1% gains on that. And keeping in mind as well, this is a pre-tax strategy, and which isn't a particularly, it's not you probably on an after-tax basis, you might have even ended up behind on that time period. And then, within 2 years, all of a sudden you've just blown all those losses. And so it's this idea about, well, if you're actually saying, well, no, I'm going to take an equal weight bet on stocks, you're actually taking this really big factor bet. You're actually saying, I think small caps are going to beat large caps. And so so you're sort of stuck into this mentality. But most funds are doing the S&P 500 type thing. I'm just buying them in their weights. What it does mean, though, is let's say the market doubles overnight. The fund managers have to do nothing. So if you've got that fund, or even if you just said Nvidia doubled, let's say Nvidia doubles overnight and everything else stays the same. Well, I don't have to go buy more Nvidia because yesterday I had 100 shares at whatever it is, $170. Today it's $340. Well, I've got twice as much of it because the share price has doubled, so I don't need to do anything. And so they tend to be lower trading in terms of what you need to do. So which makes them, one more attractive thing. You just wait for the money to compound within it. But it also means that the idea that when Nvidia doubles, all of a sudden people need to buy more of it. These passive funds need to buy more of it. That's not true. But what is true is anyone putting more money into the stock market tomorrow. So today Nvidia say 8% of the index, and I invested $100 in it. Well, eight of that dollars is going to Nvidia. If I invest another $100 tomorrow, after it's doubled, well, now I'm buying six. I need to put $16 into Nvidia, and so so the amount of new money coming in, that sort of will make a bit more of a difference. But again, the $16 now is still only the same percentage of Nvidia, and so what does that do to the Nvidia share price? And questions over that. And then there's this other question about saying, well, even though if the market's big enough, then even though there might only be 40% of this, 50% of it's people who just bought it because it's part of the index, and the other 40% are buying it based on price. Well, if the price gets too high, they'll be out short selling it and or selling it themselves, and so that's probably enough to actually make a price signal. At some point, it probably does get too small, and maybe in some of the small caps, it does get so small that it's that all of a sudden there's not enough people making decisions and you lose that pricing power, and it's just it's a bit more volatile. Where's that level? I don't know. And the other thing is, it's there's that sort of almost that makes the assumption that people are only buying the S&P 500. And they're not, because there's, say, another index called the Russell 2000 index, which is all the companies between 1,000 and 3,000 in the US. And so that's all the smaller ones. And so if people stop buying the S&P 500 and start putting the money into those ones, well, now all those stocks will go up and the S&P will fall. And so in a way, what's happening, sort of the argument there is saying, well, now it's saying, well, if people are blindly buying large caps, then yeah, those are the ones that are going to outperform. That's why they're outperforming. But you then have asset allocation people, or somebody's making a decision. No, I'm not going to buy the S&P 500. I'm going to buy the Russell 2000 index or whatever it is. And so there's another decision being made there. And so and there are some micro cap funds that buy all the little ones. You can sort of go through that all the way. So I'm not particularly concerned about saying that we've lost pricing power at current levels. I do think there's room for active, there's room for passive. I do think at some point you don't get it. You get such the free float's too small, but I don't think we're anywhere near it, to be honest. And there's lots of ways you can short these things and buy options and do all these other things. It's going to affect the price, and so there's lots of money made from people, that are trading these around. Will it go into the index or not? And so I think there's certainly things around that where it's lots of people actively investing and giving price signals, I suppose, that make a difference.
Yeah, and it shows you again that the complication below the surface is worth understanding, right? That there's a lot of moving parts to this. As we said, it's the economy isn't the same as the stock market. The stock market, of course, is made up of lots of different companies and in different sections of different markets. So the Russell versus the S&P 500. And then within markets, individual stocks. And this was quite an interesting slide that the AFR showed. This is the top contributors and detractors to the ASX 200 year to date, right? CBA, the top 16.8, then Westpac, right? And then NAB and ANZ down there, so the banks, and then Wesfarmers and a couple of others, and Evolution Mining and Linus Earth down near the bottom, right, of that list.
And so, I mean, I'm not sure what numbers would go behind this, but my guess would be, Evolution Mining is probably up way more than CBA is up.
Yes.
But it's just way smaller. And so, it might be up, I don't know, who knows? Let's say it was up 50% and CBA was up 10, then that might have given you the same, or sorry, it's up 16 and a half. So CBA might be up 20% and Linus might be up 50%, and that chart might still be, give you an indication.
And that's really the point, isn't it? About you need to understand the assumptions behind these charts to be able to make any sense of it all. Otherwise, you can completely get confused. And look, here's the other side of it. This is the drop. Now, CSL dropped 13%, right? The reason, of course, was they were going to sell off effectively part of their business into a separate company. And so the point I'm trying to make is it's important to go below the surface when you start seeing some of these numbers being thrown around and people sort of arguing for a particular position, because there's a lot of granularity that's missed in a
Mm.
lot of the commentary. And I think that's an important point to take away.
Yeah. And then the other question, but some people look at that and go, right, CSL went down. Um, does that mean it's forever bad? It's always going to go down, or does it mean then it's time to bounce back? And same with the flip side, is CBA,
Mm.
yeah, it's
Mm.
up the most, or it's contributed the most. Therefore, does that mean it's always going to contribute the most, or does that just mean it's in a price bubble? And so, with all these, really important to be looking at the earnings figures and the numbers behind it. So we've sort of used that CSL fall to buy a little bit more. Like CSL has been expensive for a long time. The earnings have still been pretty good.
Mm.
And as I've seen Fraser coming up saying CBA looks like a massive bubble. CBA does look like a massive bubble. Yeah, it's the
Pretty,
most expensive bank
pretty,
on the planet, just about.
yeah,
Yeah.
exactly. Pretty much everybody is saying that they don't understand where CBA prices have come back a little bit from their peak, but even so, it's
Mm.
still extremely expensive relative. I mean, it's only a bank, and it only does the basic same things as Westpac, right? And you look at them too and think, don't understand. But markets are
Yep.
markets, right? Um,
Mm.
so let me take the conversation forward. I want to sort of just do a little bit of a segue. I mentioned the GDP numbers, the latest from the Australian, that sort of contributions to the GDP are coming in now. This is actually the data that came out today. And basically what they're saying is that it's looking pretty fragile. Economic recovery, quote, fragile and unconvincing, analysts warn. That's what Westpac wrote. But this is the real interesting one. It's about the public demand by component. And within that, what's fascinating is that it's actually the public investment which is dropping. So the government is investing less in the future, but the public consumption, in other words, spending more on the everyday things, is continuing to rise. And that's not necessarily a very good story in terms of the overall economy. And then when you actually overlay the current account balance, which shows again it's negative, it shows you that the Australian economy is looking a little bit shaky still. And I guess we said that the GDP is not the economy, but when you start seeing weak GDP numbers like that, how do you sort of read those then into what the markets and therefore stocks might be doing? Because it's not a one-to-one correlation, is it?
No, not at all. And particularly so for the Australian market, where resources companies make up a huge portion of our index, way larger than what you see in other markets, and they're really global stocks. Like what they do is not affected really by the Australian economy. CSL exactly the same. Like they get so much of their revenue from overseas. They're a global stock that happens to be listed in Australia with a small fraction of its earnings over there. You can go to a host of other ones, Goodman Group, Macquarie's got a reasonable amount in Australia, but there's still plenty of that's overseas. You can sort of dig through these stocks where you're basically like saying, okay, there's what do how much of this is really what Australian GDP doesn't really affect CSL, the global sales of blood products or whatever it is they're selling within each division. So yes, that's one part, and they're the biggest stocks in our economy. The banks are obviously very much leveraged to the housing sector, so I do think that's a that is a you do need to sort of look at what's happening there, but keeping in mind that banks are not the same as ordinary industrial stocks. So your bank is much more interest rate sensitive. So what's happening on interest rates is extremely important to them, and they're effectively charging these. They're effectively taking the other side, I suppose. They've got the equation to a lot of companies in terms of supplying capital. And so, so just a very, very different beast and very levered. Like they're just so much debt sits within banks. They don't call it debt, but in terms of your actual ratio of money in there to uh the amount of money they've borrowed versus the amount of money they've put in themselves is a massive amount relative to other companies. Um, so that's banks. So then you do start getting in a lot of the small cap sector within Australia. That's where you're much more likely to see what's happening in the Australian economy affect those. So if you're buying small cap stocks, and the small cap stocks tend to be defined as stocks between the 100 and the 300 is what if you look at the small ordinaries index in Australia, that's what they are. Most of those are going to be very levered to the Australian economy. Some of them won't be, but yeah, a lot of them will be. So you sort of we'd sort of see that come through. Yeah. So uh, I I tend to think of the Australian economy in sort of Australian stock market in sort of four sort of biggish buckets. Is resources in one, banks and banks in another, the international stocks that happen to be listed here, and then finally getting back to the Australian stocks, and you can break it down obviously a lot further. But in terms of making big calls, that's really where am I buying banks, resources, international stocks, or Australian domestic stocks is sort of like your large. That's what's going to get you most of the outperformance or underperformance versus the Australian stock market, and then going in and trying to pick the best stocks within those groups is sort of the next phase of it.
Absolutely. And some of the results haven't been too bad, actually, through the last results season. Others a little bit disappointing. And what's fascinating to me is that the amount of international interest in investing in Australia does seem to be rising at the moment. Maybe because it looks a little less insecure than some other places, or maybe it's a proxy for China. I'm not sure, but it is interesting. I was talking to somebody the other day who's saying, wow, we've never had so much interest from overseas investing in Australia.
Right. Yeah. Well, the other thing is which is a great feature of the Australian market for Australians investing, is that the Australian dollar tends to act as a buffer for us and a supercharger for foreign investors.
Mm.
And so what do I mean by that is, well, when the world economy is going well, then typically you see the Australian dollar rising. Australia's got a lot of natural resources and things like that are exporting, and so we tend to do we tend to go stock market up and currency goes up, and then vice versa. When markets are going badly, stock market down and Aussie dollar down. And so if you're sitting in the US or you're sitting in the UK or Europe and you're investing in Australia, that gives you this double whammy. So yeah, I invested. The stock markets went up 10%. The Aussie dollar went up another 5. I made a 15% return. Fantastic. Vice versa, the stock markets fall 10%. Currency went down, another 5 or 10, and all of a sudden I've lost 20%. Um, as an Australian investing out, you actually that actually turns into a bit of a buffer for you, because what it means is when things are going really well in Australia, and markets are all going up, is the Aussie dollar takes a little bit off the top of what you're getting. So rather than getting a 15% return on US stocks, I only got a 12% return because the Aussie dollar took the top off it. But then vice versa, when you get these market falls, you tend to see the Aussie dollar fall as well, and it helps to buffer your losses. So you might see the US off 20%, say earlier on this year, but the Aussie dollar gave you back, I don't know, 6 or 7% of that, and so you might have only been down 12 or 13 in Aussie dollar terms. So.
Now, there are three other issues I want to touch before we end today. The first is the bond market, Damien, and I want to put this slide up to sort of start that conversation. So the long bonds in the US, Japan, Germany are much higher, right? And in fact, the bond yields in the UK hit 27-year high, pound slid as a result. So there's something going on in the long bonds, and I'm fascinated by this. In fact, Perrin asked a little while ago about the 30 UK bond. It's exploding. There's something significant. Now, why is my interesting sort of hypothesis? Well, maybe it's to do with the expectation of inflation. Maybe it's the fact that the debt levels in many of these countries are suddenly accelerating. Germany, of course, is investing a lot more in defense. The UK is having to borrow much more than it thought it was going to be earlier on. So it's a potential signal of that, or is it a signal of hyperinflation and all of those sorts of things?
Yeah, I think it's a sign. It's a little bit of a sign of inflationary concerns around tariffs and things like that. But I think the biggest sign is actually that there's there's been a change in politics, and so in the financial crisis, in Europe in particular, we had this big, this major financial crisis, all this money lost, and the immediate reaction of many of the governments there, particularly the Northern European one, back on what's pull back on the purse strings and not be countercyclical in terms of that. And and they had a lot of rules around, how much deficits could be, and it was all about, being sustainable in terms of the amount of money that you're going to borrow. We hit COVID, and sort of the opposite happened is governments went, hey, money, let's throw it everywhere. Let's get money out there, out the door, give to everyone, and relearn about this sort of fiscal stimulus things. And fiscal stimulus worked really well at keeping growth and unemployment in check. It worked too well in terms of creating inflation, but it worked very well politically. Like there was pretty there's pushback from some, but there really wasn't much pushback. Like most people were happy to be throwing extra dollars and things like that. And I do think politicians are followers, not leaders, and they tend to go, well, that worked pretty well, didn't it? So I can spend money and nobody really complains that loudly. And I pump up the economy and I give money to my the donors and the people that supported me and the downside is maybe there'll be higher inflation later, but that sounds a lot like something that's going to happen after the next election cycle, and so we'll leave that for the politicians to follow. And I think Trump, obviously, coming into power and even getting into power, there was all this Doge, and we're going to make all these cuts, and we're going to have deficits of 3% and all this stuff like that. And once he got there, is decided, well, you know what? Actually, I'm just going to run. That seems like a lot of work having to cut things. Why don't I just spend more money? And so I think there's a growing recognition from markets that that's going to be the way of the future. Is we're sort of going to usher in a set of politicians that are going to be want to push the limits. How much more can we spend? How much more debt can we go into before it actually causes problems? And I think markets are reflecting that that's going to be the way of the world. And I think in a lot of those countries, we're probably seeing short-term rates as well coming down. And so it's this idea that, things are going to be tough in the short term and probably cutting interest rates, but in the long term, politicians are going to be outspending money, and that means inflation's higher. Just seeing Cookie Boy coming up with Peter Schiff talking about 2%. I think the Albert Edwards is a pretty famous bear who works for SocGen. He's always writing about bad stuff. But his red line was Japanese 30-year bonds at 3%. That was his key one. And his argument was that, for the last 20 or 30 years, basically people have been taking cheap debt from Japan and funneling it out to the rest of the world, and that's what's been sort of pushing it. And they left 3% in the rearview mirror, I don't know, a few weeks ago. And so markets haven't crashed yet, but he's certain that that's the level. Look, there's certainly, I think from my perspective, I think when long bond rates move really quickly, you do need to be concerned about what that's going to do to markets. And I think there's UK went through its Liz Truss moment, in inverted commas, where we saw the long bonds in the US, sorry, the long bonds in the UK spiked sharply, and then all of a sudden, all these pension funds over there all started to run into these problems where they'd had these trading strategies that basically relied on that not happening, and then that was causing problems, and the whole question about whether that's going to bring the financial system undone. I think when you see things move more slowly, that's less likely to happen. But when you do see some sharp moves in some of these, you do have to wonder, look, are people taking bets on the other side of that? And that was, there was again, for the students of history, sort of back in the late 90s, we had this long-term capital management that was basically making a lot of fancy bets in the end that basically, amounted to going short the 8-year bond and long the 9-year bond, or vice versa, or whatever it is, and then waiting and trading that and switching that position out. So really they were taking, and these are government bonds, so really not taking very much risk at all, but just doing it in massive quantities with all this leverage. And then a few things happened, and all of a sudden they couldn't do that, and then everyone found out they had these trades on, and everyone started trading against them, and that caused this massive potential meltdown for the entire financial system. They're the types of things that can happen when bonds move in directions quickly. So over longer periods of time, um, higher bonds probably mean lower prices for stocks. But there's a all else being equal, and that's really important. That word's all else being equal, because if long bonds are just a reflection that actually we're just going to be in a higher inflation environment, maybe inflation is going to be 1% higher than what it has been, over the next 20 years than what it was over the last 20 years, then where am I going to put my money? Well, actually, stocks is traditionally been a pretty decent place to save you from inflation. So yeah, depends upon there's lots of other things go into that, but if it was just that you're looking and saying, okay, everything else being equal, I'm just expecting 1% higher inflation, then long bonds go up. So bonds go down, but stocks may or may not be affected by it. There's a reasonable chance a reasonable argument you can make saying, well, stocks are still, maybe they're slightly less attractive, but they're still attractive because they're probably going to grow 1% faster with higher inflation.
Now, I've got the view that the stagflationary forces are still gathering, right? We're still seeing the inflation, a little bit higher and
Yeah.
moving up possibly. We're still
Mm.
seeing the money supply blooming, despite the fact that
Hmm.
central banks are actually buying back some of the bonds in some cases. The Treasury in the US is issuing a lot of short term and buying back long bonds to try and sort of change the funding. But the question, of course, is how does it all play into an investment strategy? And I think the bond story is one that people need to get their head around, because there are some important consequences. And of course, to an extent, the bond vigilantes, whether you believe they exist or whether they don't, is something that markets actually more broadly will take account of.
Yeah, that's right. And so as an example, within our active portfolios, we sort of took a bet, I don't know, 6 months ago, and just said, look, we're just going to pile into the 3-year bond in Australia rather than some of the longer term bonds, because um, the longer term bonds are headed up, the shorter term bonds are headed down, because it's sort of like we're worried about the financials situation and rate cuts. So the short end bonds will be anchored by what the RBA is actually doing, whereas the long term bonds are going to be going up because of those types of things. And so that's been the right play so far.
Mm.
We're going to stick with that for a little bit longer. So our 3-year bonds are now more like 2.5-year bonds. So we're sort of getting shorter every month. You get a little bit shorter in term, but we're sort of largely sticking with that at the moment. Maybe there'll be time to turn, but yeah, I think it's certainly it should be something people are taking factoring in as you're looking at your asset allocation and what you're doing in terms of risk management. Because yeah, you could certainly see cases where um, bonds typically end up being good for you when financial crises happen and things like that. But if you end up in a financial crisis or some sort of big downturn where you're seeing short-term rates cut to zero, but long-term rates, staying high or going higher, then your bonds aren't saving you. If you've got all those long-term bonds. And so for us, it's about trying to keep some of the shorter-term bonds within the portfolio to make sure that, if you do run into these problems, that you're protected. Because I think that's, my big picture case for still owning stocks, and we've got lots of cash, but for owning still what we'd call quite a reasonable amount of stocks within our portfolio, is that earnings have been good. Um, Earnings aren't the stock markets, as I said, the stock markets aren't the GDP, and within stock markets, there's a certain cohort of companies that are getting really good earnings. Is that if that keeps happening, the stock markets can hold up. Yes, they're expensive. That's sort of 22 times earnings ish, which is right up there in terms of in the top 90th percentile, say, of where they've been. But if we've just done 11% growth last year, it looks like we're going to do 11% this year, and you add another 10 to 15 again next year, then actually in a year's time, markets are, if they haven't gone up a lot, you've got a decent yield. You've got a little bit of a yield, and they're looking a lot more attractive in terms of pricing. So um, in the meantime, there's lots of things that could blow that up. So it's sort of that question about, could you see a scenario where um, Trump gets more of his people into the Fed that he wants, and I'm sure we're going to talk about that in a minute. I think that was on your list.
Yep.
Interest rates get cut. You've got this sort of financial bonfire going in the US of the economy running really hot, profits really good. You've cut back on all the regulations. Um, you've managed to get through the worst of the tariff stuff, and all of a sudden companies are growing earnings at 15-20%, which quite often happens in peak cycle stuff. 20%, if you had 1 year of 20% earnings growth, then markets are back to much more average in terms of the pricing. And so pricing is important. I don't want to underplay the pricing end of it, but more important for stock market returns is earnings. So if you're seeing the earnings come through, the stock markets can hold up and end up looking cheaper.
And a couple of observations on that. The first is, of course, the long bond has a very significant impact in the US on the housing market because, of course, a lot of the bonds are actually used to price mortgages, and long-term fixed rate mortgages in the US are the standard. And so one of the things we are seeing at the moment is quite a slowdown in housing purchases and transactions in the US because of the fact that the interest rates are still sticky and staying very high, which I think is quite interesting. So that's a real life impact. Now, in Australia, of course, we don't have quite the same impact. So, in fact, we are seeing some of those mortgage rates in Australia moving down a little. In fact, there was a 4.8 something I saw the other day, which I think was one of the lowest I'd seen for quite some time. But a lot of mortgages are still above 5. And in fact, some others are still in the 6s and the 7s. And if the long bond story continues to go that way, there's going to be a limit on how far mortgages can come down. And I think that's going to be something which central
in
banks.
The US.
Yeah. So I think that's quite fascinating. And that then takes us quite nicely into this issue of the Fed, right? The Fed is basically saying, well, we're not sure. Tariffs haven't worked through yet. We're not sure whether it's going to really have a big impact on inflation, whether it's going to be one-off. If it's one-off, we can look through it. Therefore, we should be taking rates lower. On the other hand, if inflation is going to be more sticky, as it looks it could be, we may have to sort of not take rates lower. And so Trump and his cohorts have been talking the Fed down and saying, no, drop your rates. And then, as he said, with the Lisa story and the other stories there, trying to actually stack the board with people on the Fed that actually will follow the Trump story. And that takes you then directly to the question of Fed independence or not. I would argue that the Fed has never been as independent as he claims to be, but nevertheless, we are potentially seeing a very political Fed, and that's going to be an interesting thing to factor into people's thinking about how to think about investment.
Yeah, that's right. I'm going to start with one of the ironical ones is that the Fed member he's targeting at the moment, Cook. She's actually been one of the biggest doves on the board. So in a way, whoever he puts in there probably doesn't make much difference to the overall, the short-term nature. It damages the perceptions and all that type of stuff like that. But the short-term effect of it is probably not actually that much in terms of, yes, I replace somebody who's a dove with somebody who's potentially more dovish, but there's still just one vote for cutting rates. So that's the ironic part. The other part, and I've spoken in the past with you about this, is that look, yeah, would it be the worst thing in the world if central banks weren't independent anymore and they were all beholden to the government and like they were sort of 20 odd years ago or whatever it is? And you're like, well, look, to me, no, it wouldn't be the worst thing in the world. Like you get times where you got governments working at cross purposes. They've got governments have fiscal policy and there's monetary policy, and we saw it in Australia where the RBA is trying to cut rates and worried about trying to get inflation up and wage growth going. In the meantime, we had Abbott talking about I've got to have surpluses. I've got to have surpluses. We're back in the black, and Morrison going through that whole part is like, just a minute, you guys are jamming on the brake while these guys are trying to press on the accelerator. Who's running this economy? And so I do think there's a certain amount politicians hide behind the whole fact of like, yeah, we might have stuffed up the economy, but it must have been the independent central bank that did the worst thing. It wasn't me, it was them. And so, whereas if you're saying, okay, well, now you're running both, here you go. And so, is that the worst thing in the world? No, I don't think it is. then you get to look, do I think Trump has got all the necessary capabilities and of running this thing? You know, the do I worry about the that he may not be the right person to be putting in charge of this? Yes, I do. I worry about his, his the whole idea of attention to detail and all that type of stuff like that is not his strong suit. And yeah, I've got a bit of a story about NVIDIA, which I wanted to get to at some point, which I'll talk about. It's a great example of that as well. Um, but I do think there's so yeah, so uh, I think financial markets would take it badly if the the less independent the central bank is. Do I think there would be a meltdown and we'll see bond yields at 10%? No, I don't. Could you add another 1 or 2% to it? Yeah, maybe. Would I be surprised if it only added 0.5%? No. So I don't know. I guess I think it's something which people worry about, but they get used to it pretty quickly if it happened. And I think in a similar way, Trump's done a lot of things that sort of really push the boundaries of what a president, can and can't do. Um, and people talk about it being this is going to be the worst thing in the world, and then when it's done, it's like, well, let's done, it's done. Let's just get on with it and do what we're doing. So, and a lot of these things, I think, um, big picture wise um, as a microcosm, getting rid of the Consumer Protection Board or whatever it was that sort of set up during the financial crisis to protect consumers, getting rid of that and getting rid of a lot of the regulation on that. Do I think that's a good thing? No, no, no. I think that's going to cause problems. Is that going to cause problems in the short term? Almost certainly not. It's probably going to take a boom in the meantime. Like you probably need a boom, some sort of financial boom where people are out selling whatever it is, crypto coins on a levered basis or whatever it is that's going to happen that'll cause some massive blow up and that'll be a boom and then a bust and then we'll go and put another one of these things on. But I think that these are I think a lot of the stuff he's doing have some short-term positive impacts for growth and longer-term negative impacts for growth. And that's in a way what the long bond's telling us with a lot of the stuff I think is that's similar is that yeah the economy's not looking good and all these things like that but we think politicians are just going to spend more money and push up inflation eventually so we'll push short-term rates down and long-term rates up.
Absolutely. In fact, I made a show the other day called Pop Goes Independent Central Bankers, and I discussed the whole question of how independent are central bankers and, some of the recent historical stories. Of course, Nixon and how he influenced one certain central banker in terms of actually taking interest rates down and the inflation that resulted. But I also made the point in that particular piece that I did that when you look at who's been writing about the importance of independence of central bankers and central banks, guess what? A lot of them are actually central bankers and ex-central bankers. So they have a bit of a vested interest, right? And economists who have a particular view of the way the economy works. So to my mind, it's probably not as critical an issue as many people are actually making it out to be. And there are alternative models that people think about too. Now, as we come towards the end of the show, two quick other questions. Obviously, we should touch on the gold story because the fact is that gold is touching new highs again, and I think this is quite an interesting and significant issue, possibly on the principle, of course, that everybody talks about gold being the safe haven in time of trouble. Although you wonder about that. But the other interesting data point, which I wanted to share with you, was this one, and this is actually the fact that foreign central banks now hold more gold than treasuries for the first time since 1996. So I think there's more to it here than just a safe haven. I think there's something structural going on too. But what do you think?
Absolutely. So the foreign central banks is I think a lot of this is just based around what happened with Russia having their reserves seized and with the Ukraine war. So I think if you are any uh, country that's not a close ally of the US, so whatever it was, you're I don't know, Thailand or Bangladesh or India or wherever, pick whatever country you like that's not, tied to the hip to the US in the same way Australia is, then you looked at what happened and went, could we potentially do something that the US could decide that they want to take all our funds as well? And do we want to be dictated by that? Maybe we need to diversify. And so that's where I think you get a lot of that from is just other, yes, and a lot of these might only be smaller countries, but as a whole, I think central banks will be thinking about along that perspective. And then, so that was, I think, the first part of it. The second part then is um, with Trump in. I think even if you are a or were formerly what might be considered a very close ally, you might be rethinking as well and saying, well, do I think that we could do something that Trump decides, putting a tariff on it isn't enough, and he's going to decide to seize some of our central bank holdings or do something, like that. Maybe there's even some developing countries that are sort of started to head down that path of saying, well, if we're uncertain, maybe just don't put every egg in that US dollar basket. And so, yes, I think you've got that. The other thing I think is a major issue with it is with gold is I've spoken before as well in the past about one of the key drivers of gold is being as a currency, an alternative currency, say the anti-US dollar. And so I think if you take that sort of angle on it, is the idea is, well, if the US dollar is weak and the US dollar has been weak, then it often means that that's, given gold is one of its effective things that it does is being a currency, is that means it's, a stronger story for the gold price.
Absolutely. And I think there's a nice segue then into this story, of course, where they're currently in China, having had roundtable discussions, and they're going to do a military parade shortly. But India, Russia, China, talking about a
Mm.
multipolar world and all of those things. And to my mind, it's fascinating to me that a lot of the gold purchases are actually made from countries who are aligning themselves in this multipolar world, which I think is fascinating. And interestingly, people in China and India, they're not now just buying jewelry as they used to. They're actually buying into the gold and gold financial instruments, which is
Mm.
also adding more reinforcing as well. So I do think there's a connection between the multipolar story and gold as well.
Mm. Yeah, absolutely. And also, you're a rich citizen living in China, India, Russia. Do you want your money in US dollars, or are you worried? You've seen the US seize these assets of your country. Do you worry that they're going to start seizing your assets as well? And so that's probably a legitimate concern that you might have, is that you might not even agree with what the politicians are doing, but from a safety perspective of your own, you're thinking, well, do I want to? Often, I think rich people in these countries don't want all their money in rubles or rupees, and so they're often buying US dollar assets, but they're probably thinking now, well, maybe I don't need as many US dollar assets. Maybe I need some other ones just in case Trump decides to punish India in other ways or whatever it is. So.
Indeed. And,
Mm.
I'm sure we will in future shows talk further about the
Yeah.
consequences of multipolar and how it all plays out.
Yeah, and the other one I know we're obviously running out of time. I should touch briefly on it though. Is that that falls back to this idea as well that the stock market is not the economy, and that's way more true in countries like China and India and Russia than more developed countries. So the number of companies that are listed there is way smaller. Uh, the amount of business, the amount of money in sort of either informal economies or small and medium business is much larger, and the sectors there tend to be dominated by a couple of quite often it can be three or four companies that might make up 50% of the index. And so, and often if they are things like resources companies, say Russia, again, it's just nothing to do with the Russian economy really. It's what's your oil price doing. And so, and India's, while it's got yes, some exposure there. They do have some big energy investments. They do have big companies that are IT services to the US and things like that are just not as related to the Indian economy. Mm.
Yeah, and
Oh,
just
sorry, in China. Oh, sorry.
go
And
on.
China's the other big one.
Yeah.
When you invest in China, if you're investing in, say, a Chinese, say, an index in China, just keep in mind that what you're really getting is a whole bunch of state-owned entities. And that might not be what you thought you were getting. Like you're like, oh, I'm going to get all this great growth by investing in China. And you're like, just a minute, own all these government corporations who are basically told what to buy and where to invest their money. They're there to keep, the economy fully employed and whatever it is. How do they end up with these stocks as the basis of 50% of my Chinese portfolio? And So yes, so China in particular, I'd be yeah. There's an active versus passive debate in most markets, but in that you can sort of have with some reasonable part. But China in particular, I'd say the passive argument's much harder to make. It's have a look at the actual companies you are going to get in China's probably
Hmm.
well worth doing.
China's markets, of course, have touched all-time highs, interestingly.
Mm,
And the
yes.
expectation there is more government support and stimulus and all those good things. So,
Mm.
as we come to the end of the show, Cookie just asked a question about oil. I'll just sort of show you the current story on oil, which is this one. It's gone up a little bit. And of course, the expectation is the demand from the US will come off because the driving season's over. The OPEC Plus are talking about increasing production levels. And so I think the expectation that I've been reading, Damien, is that it's unlikely we're going to see oil spike unless we get a huge conflict escalation. And that will be presumably because of the Russia story more than anything else.
Yeah, well, we obviously had some fireworks with Iran. That's probably the other big one. Is you can certainly see issues there
Mm.
flaring up again. I think more recent headlines, as you said, have been a lot around the Ukraine attacking a lot more of the Russian supply,
Yeah,
and
about 20% or
I think
something they're claiming. 20%.
yeah, that's quite an interesting one in terms of um, apologies. A few years ago, or you went back 10 years and you said, okay, if you were going to fire a random rocket at a refinery, it actually did way less damage than you'd think. Like refineries are pretty big. There's actually pretty hard to hit the crucial parts. But the drones now and cameras and all that type of stuff means that it's actually getting much easier to hit the crucial parts than what it used to be because that they can apply it into the most important parts of it. And so, yeah, there's some genuine. Sorry, and then as well, the next part was that the rumor was, and or at least the sort of the chatter was that Biden was had been quite was sort of encouraging the Ukraine very much not to attack the oil facilities in order to or in any major way because he wanted to lower oil prices. Now, could I see Trump do the same type of thing? Yep, absolutely. I can see him decide that yes, Ukraine, you can start firing at this other stuff, but you got to stop firing at those because I want to keep oil prices low. Um, but that's one thing that could certainly spike oil prices. I do think economically we are looking at a slower economy in terms of a lot of say things like transport and travel and things like that. That does seem to be affecting it. So that's probably on the weaker side. As you said, supply looks pretty good, absent maybe some serious disruption to Russia. And then you've got, probably the biggest wild card is, what India's complaining about, which is, Trump decided that because India's selling Russia oil, that he was going to add an extra, 25% or whatever to their tariff. Well, Russia also sells way more to China.
Mm.
So, I'd probably say that would Trump genuinely say that he's going to say anyone who buys Russian oil is going to get get these tariffs on it and be serious about it as opposed to just picking people out. That's probably your biggest risk, and that could do a fair bit, I would think, to the oil price in terms of the upside. So to answer, I guess, Cookie Boy, look, I think the fundamentals point lower, but there's Trump's your biggest wild card, and so absent him doing something weird, I think you probably end up with lower oil prices, but who knows?
Mm, that's right. Who knows, indeed. Well, we've come to the end of the
Mm.
show, Damien. Thank you very much for your time, as always. Really interesting. And I think the summary is quite a lot of uncertainty still out there. So, always
Mm.
think about what if the counter happened rather than just go, ho, let's throw this in. Markets are still
Yeah,
quite expensive, but some of it's sustainable potentially because, as we've argued, it's not the same as perhaps it was previously. We've also got some of the unknown unknowns. What Trump's going to do, and what the story around China is going to be. But the story, I think, is not to panic in the current situation, and not necessarily to assume that things are going to go horribly pear-shaped over the next little while. But the risk is also there that things could take a little bit of a check. And remember, in September and October, the markets tend to be a little bit sideways or down rather than up.
Yeah, I think there's a lot of landmines. If we make it through without stepping on any of them, then yeah, can certainly see markets higher. But it's really about trying to work out where can things go wrong. And the thing we're really watching is company earnings. I think that's the real key to it to us. And at the moment, company earnings are strong. They're getting stronger. So yes, keep a close eye on that. And I'm sure we'll talk about that again next month.
We'll look forward to that. So hopefully the first Tuesday in October. That'll be a fantastic time to catch up again. So thank you very much, Damon. I really appreciate all your thoughts, insight, charts, etc. I'm going to take you offline now, and I'm going to close the show. We'll see you in a month's time. Thank you. So there you go. I hope you found that interesting. And I always love talking with Damien about the the real intricacies of what's going on. I think we learned quite a lot today. So thank you, Damien, for that. Jason, thank you for the super chat too. Really appreciate it. It really helps to cover the costs. So thank you once again. And just to say that next week, I'll be covering the latest from my surveys. Quite a lot of new information, some quite concerning information in those surveys. And I've got a few other little things to share with you next week as well. So look out for that. And of course, the daily shows, recorded shows, will be coming out each day of the week. So check out for those. I've got one dog to show you. The other dog is around the corner, but Luna is sort of still there, sort of hanging out, having a... Oh, there's the other one just around the corner. There you go. You can see a bit of the other one. That's about how far I can go. So there you go. The dogs are still there. Thank you very much for spending some time with us this evening. Really appreciate it. And hope you have a good evening. Keep safe, keep well, and we'll look forward to seeing you next time. This is Martin North from Digital Finance Analytics signing off. Take care.